Today, we will talk about insurance underwriters and what they do. Insurance underwriters analyze and evaluate the risks involved in insuring people and assets. They use specialized software and actuarial data to determine the likelihood and magnitude of a risk. The term underwriting means receiving remuneration for the willingness to pay a potential risk. Insurance underwriters establish pricing for accepted insurable risks. Underwriters in investment banking guarantee a specified amount of capital to a corporation during an initial public offering, promising to provide those proceeds of the sale to the client, regardless of the success or failure of the sale of its company's shares. Insurance underwriters assume the risk involved in a contract with an individual or entity. For example, insurers must consider numerous variables when rating a homeowner's policy, evaluating hazards and risks that may trigger a liability claim. An algorithmic rating method is employed to pricing. Commercial banking underwriters assess the creditworthiness of borrowers to decide whether the individual or entity should receive a loan or funding. The borrower is typically charged a fee to cover the lender's risk if the borrower defaults on the loan. Medical stop-loss underwriters assess risk based on the individual health conditions of self-insured employer groups. Stop-loss insurance protects groups that pay their own health insurance claims for employees rather than paying premiums to transfer all of the risk to an insurance carrier. Here are 4 key takeaways. 1. Insurance underwriters evaluate the risks involved in insuring people and assets and establish pricing for a risk. 2. Underwriters in investment banking guarantee a minimum share price for a company planning an IPO, initial public offering. 3. Commercial banking underwriters assess the risk of lending to individuals or lenders and charge interest to cover the cost of assuming that risk. 4. Insurance underwriters assume the risk of a future event and charge premiums in return for a promise to reimburse the client an amount in the event damage or occurs. Hope this would help. Thanks for watching.